Well, good morning or good afternoon, depending on where you are, where you may be. Welcome to Kaplan Financial Education's webinar series. My name is Gigs Taylor-Stephenson, and I am the National Director of Academic Staff for the Financial Services product lines. However, I came out of instructor retirement to be your guide through the wonderful world of options. Now, this is the first of 3 option webinars. We will be covering hedging and advanced options strategies, but that's during next week's webinars. Today, our journey will begin with basic options. I'm going to be joined by my good buddy, Mark Esposito. Some of you may have remembered Mark because he was the presenter on our first webinar during this series, but today he's moderator Mark. So sit back, relax, and after this webinar, you should be able to define an option contract, recognize a type, class, or option series, understand the actions of buyers and sellers, identify the components of an option contract, determine if an option is in, at, or out of the money, and last but not least, calculate the break-even, maximum gain, and maximum loss on various options. So let's get started with the definition of an option. An option is a contract between 2 parties. The 2 parties agree to either purchase or sell a specified amount of a specified security by a specified time at a specified price. Now, of course, I don't think you had enough time to write all that down. So I'll slow it down a bit. An option is a contract between 2 parties. They agree to either buy or sell an underlying security. And there are going to be standardized terms and standardization with that option contract. So let's dissect the definition a little bit more. First of all, we have those 2 parties. First one I'm going to call investor A. Now, investor A is long, also known as the buyer or the holder of the option contract. Now, since I bought the option, I'm going to pay the cost of the option, which is considered the premium. And I just paid for the right to buy or sell the underlying security if the investor decides to exercise. On the flip side, I have investor B. Investor B is known as the investor who's short or the writer or the seller of the option contract. Now, if you sell something, that means you're going to receive money. And of course, what you receive is considered the premium. That's what the option cost. That's what the buyer pays and the seller receives. But the seller does not have rights. They have obligations. So the seller is going to be obligated to buy or sell the underlying security if they're assigned an exercise. So to recap, buyers have rights, sellers have obligations. Now, if we look at 4 different option contracts, we can categorize them based on the type of option, the class of option, and a series. if we look at the types, there's calls or puts. So going back to the 4 option contracts, I have an ABC call, another ABC call, and it looks like we have a call down at the bottom. So we have 3 out of the 4 are call options. But look, we've got a put option here also. So looking at the 4 option contracts, it looks like we have 2 different types of options represented. Now, of course, if we had all calls or all puts, then we would only have 1 type represented out of the 4. But options can be further categorized based on the class of option. That's your same type and same security. So while we have 3 calls, 2 out of the 3 are representing ABC calls. And then, of course, we have that put in there. And then the last one is a GST. So it's a different security. So out of the 4, we had 2 types, but 3 classes. But when we trade an option, we trade it in terms of a series. An option series is the same class, same expiration, and same strike price. We'll talk about what those terms mean in a bit. So we've got an ABC call and another ABC call. But if you notice, one is a June 60 call and the other is a June 70 call. So even though both of them were in the same class, they're now 2 different series of options. And of course, by default, we have our put, and our last call option is a GST 60 call. So I haven't changed any of the option contracts, but as you can see, they could ask you a question: how many types, which we have 2, how many classes, where we have 3, and then how many series, which series would number 4. There's going to be lots of charts and tools to use when you take your exams. And for options, some of you have seen this before. Some call it the option chart, the option cube, the option everything, whatever you call it, up to you. And if you choose not to use it, I'm fine with that. However, make sure that you're getting all the questions right. So I like to basically put my definition in chart form. So remember our 2 parties. One investor is going to be long, or the buyer, or the holder. Doesn't really matter what sequence. As long as you remember, if there's a long, there's a short. For every buyer, we've got a seller. And for holder, we have a writer. So an option's a contract between 2 parties. And the 2 parties agree to either purchase or sell based on the type of option. And remember, we only have 2 types of options. We have calls and we have puts. So you can buy a call or sell a call. You can buy a put or sell a put. If you buy a call, however, you've bought the right to do something. If you buy a put, you've also bought the right to do something. But what do you have the right to do? Well, let's see. Buying a call gives you the right to buy the underlying security. Now, that's all well and good, but who are you going to buy from? Remember, there's 2 parties to this contract, so you're going to buy from the seller. The seller will be obligated to sell the underlying security to you. If you buy a put, you still have the right, because remember, when you buy an option, you have the right to take action. But this time, the action we're going to take is to sell the underlying security. So buyers of puts have the right to sell. And who are they going to sell to? We're going to sell to the other guy on the other side of the contract. The other side of the contract will be obligated to buy. The one good thing about options, a lot of it is basically the opposite. If one has the right to buy, the other one must be obligated to sell. If one side has the right to sell, the other side is going to be obligated to buy from the seller. But whether or not you have the right to buy or obligation to buy, the end result is you're going to end up buying the underlying security. And when you buy a security, well, if you're like me, you want the price of that stock to go up. Now, on the flip side, if you're selling the security, whether you have the right or the obligation, you definitely want to make sure you don't sell it and the price goes up. You want to sell and then the price goes down. So you're anticipating the price going down if you buy a put. You're anticipating if the price is going to go up if you buy a call. But we have two animal mascots in this business, one representing the market going up and the other representing the market going down. The one that represents the market going up is the bull. So if the question really asks you, what are the two bullish option strategies? You're going to answer buying a call and selling a put. That other animal mascot is the bear. So the two bearish strategies would be buying a put and selling a call. It's important for you to remember the bulls and the bears. If you have questions, please feel free to chat them to moderator Mark, and he'll be more than happy to answer them. So as another visual, remember buying a call or selling a put, they're bullish strategies, while buying a put and selling a call, those are bearish strategies. Okay. And that's it for basic options. I hope you enjoyed the seminar. Just kidding. Just kidding. Nobody hang up yet. I'm just kidding. We're actually just getting started. So let's look at the components of an option contract. Remember, we said you could go long or short, buy or hold, etc. That's considered the action. The action. The call or put, remember that's the type. The one represents the number of contracts. And the number of contracts here is one contract, well, represents 100 shares. That's known as the size of the contract. Depending on what the underlying security is, will determine the size of each contract. But for now, we're going to stick with our equity option, and that's 100 shares. The ABC, well, that's the underlying security. October is the expiration month. In other words, this option will cease to exist on a specific date and time in October. And last but not least, the 60 represents the strike price or the exercise price. Now, it doesn't matter what happens. If you're locked into that contract, then you are going to either buy or sell at a price of $60 a share. For example, let's say we're long a call. Remember, Being long a call or buying a call or the holder of a call gives you the right to buy the underlying security. So how many shares are we given the right to buy? 100 shares of ABC by a date and time in October at a price of 60. Now, if ABC stock is trading at 55, then it wouldn't really be a reason to buy it at 60. But if ABC stock is trading at 75, then I'm happy because I've locked into that contract and I'm going to go to the seller of that contract and knock on the door. And I'm going to say, remember that contract that we entered into a few months ago? Well, you agreed to sell me that stock at $60 a share. I don't know, it's trading at 75, but I have the right, because I bought this call, I have the right to buy the stock at $60 a share. I think that's a pretty good deal. Do you always win? Absolutely not. And we'll talk about some of the calculations that you may see on the exam. But for now, let's take a closer look at what I'm going to have to pay or what I'm going to have to receive, what I'll receive for the option, the premium. The premium is made up of two values, the time value and the intrinsic value. So as we say, time value plus intrinsic value equals the premium. You won't have to calculate the time value. You can derive the time value, but you won't need to calculate it. The reason you won't need to calculate the time value is because, well, it's a challenging calculation, but you can determine the time value given additional information. Now, I will tell you, you'll need to be able to understand and calculate the intrinsic value. And of course, if you have the intrinsic value and you have the time value, then you'll also have the premium. But sometimes we'll switch things around a little bit. So here's your tip. Get it? TIP, tip. Time value plus intrinsic value equals premium. So let's say we're long one ABC October 60 call at, well, I don't know what the premium is yet. So I'm going to give you the current market value, and we're going to figure out what our premium is. So the current market value is 62. Now think about it. I'm locked in to buy the stock at 60, and it's currently trading at 62. So in my opinion, that's a good deal. The fact is that the option is in the money or has intrinsic value of 2 points. In other words, the current market value of 62 compared to the 60 gives me 2 points of intrinsic value. So calls are in the money when the current market value is above the strike price. There was a reason I put the calls on the top of that option chart. Hopefully you'll remember call up and of course puts are down, but we'll get to puts in a bit. For now, we know that our intrinsic value is 2. I'm just going to pull 3 out of the air. I just gave you the time value. And that's what they'll do on the exam. They'll give it to you. And they will determine the premium by adding the time value and the intrinsic value. So 3 plus 2, 5. I just calculated my premium. Let's try another one. Same option contract. The strike price is 60. But now the current market value is 65. With a current market value of 65, we know that our option is in the money because it's a call, and calls are in the money when the current market value is above the strike price. But this time, they gave me the premium, and they want me to figure out the time value. So, hey, wait a minute, this is easy. Because I have a premium of 9, I have to fill in, what the intrinsic value is. So I know that my option is in the money, and it's in the money by 5 points. So do a little bit of algebra here. If my premium is 9 and my intrinsic value is 5, then I'm solving for T, or time value. And of course, your time value here would be 4. How do you get good at options? You practice. So let's practice one more. In this case, we have a current market value of 64 and a premium of 4. Once again, they want us to calculate the time value. Now remember, in order to calculate the time value, I would need either the premium or the intrinsic value or the current market value so I can determine the intrinsic value. So I've got the premium, and they gave me the current market value. And I remember, because I remember from my webinar, the one that I attended, that calls are in the money when the current market value is above strike price. Current market value is 64, so I have 4 points in the money. But wait a minute, if my intrinsic value is 4 and my premium is 4, then that means, my time value must be 0. So this option is considered to be trading at parity. There's no time left on the contract. And so that means that this option is at expiration. So it must be that date and time in October that I told you about earlier. Remember, we have 2 types of options, so we don't want to leave out our puts. You're long 1 XYZ April 85 put, and this time the current market value is 81. Now, if calls are in the money when the current market value is above the strike price, then puts must be in the money when the current market value is below the strike price. And how far below are we? Well, the difference between 85 and 81, that's 4 points. Now, once again, I pulled the time value right out of the hat. I just wanted to make it 2. Did I calculate anything? No. What did I do? I just gave it to you. But if you remember the tip, time value plus intrinsic value equals your premium. So I know that this one XYZ April 85 put is trading at a premium of 6. If the current market value is 82, well, by now I'm sure you got the hang of this. Current market value is 82. Puts are in the money when the current market value is below. They gave me the premium, so they're probably going to want me to calculate the time value. So with an intrinsic value of 3 and a premium of 8, I can easily calculate the time value, which is then 5. Last but not least, 79 is my current market value, and that's below 85, definitely below 85. My premium is 6. My intrinsic value is 6. Hmm. So it looks like, once again, I have no time value left. So I think this option actually expired today. So this option is trading at parity when the intrinsic value equals the premium. There's no more time left on the option. The option has expired. That was just a coincidence. Okay. So as a recap, calls and puts. Calls are in the money when the current market value is above the strike price. Puts are not in the money, what we call out of the money. Now, if the current market value equals the strike price, both calls and puts are at the money. Of course, when the current market value is below the strike price, calls are out of the money, but puts are in the money. Okay? So, just as a quick exercise, we've got 4 options. Long 1 ABC November 40 call, with short 1 CHS March 40 put, long 1 NTS February 57 call, and short 1 SGN June 80 put. Make sure you look at the type of option. Whether you're long or short doesn't really matter. You're looking at the intrinsic value of the type of option. Our first one, we have a call option. Calls are in the money when the current market value is above the strike price. Here, the current market value is 45. So, compared to the strike price of 40, we know that this option is in the money. Puts, however, are in the money when the current market value is below the strike price. Well, the current market value is 52, and the strike price of this put is 40. So this would be out of the money. Now, if you thought this put was in the money because it's short, shame on you. Remember, I said, don't look at whether the option is long or short. All you're going to look at is the type of option and the strike, the type and strike. You're going to compare that strike price to the current market value. Now, here's a gimme for you. The strike price is 57 and it's a call, but it turns out the current market value is 57. So this option is at the money. Last but not least, we are short 1 SGN June 80 put with a current market value of 60. Remember, puts are in the money when the current market value is below, and 60 is surely below 80. So this put is definitely in the money. So in, at, or out of the money. And remember, if the option is in the money, it has intrinsic value. If it's at or out, well, there's no such thing as negative intrinsic value. So the amount you'd put on in the test would be 0. So it has 0 intrinsic value if the option is at or out of the money. Now, we can't stop the webinar without doing a few calculations. Those calculations will be the break even, the maximum gain, and the maximum loss. And I pulled this calculator for a reason because it's the type of calculator you're going to get when you take your exam. It's a 4-function calculator. We have addition, subtraction, multiplication, and division. But for now, we'll just need to use our addition and subtraction. Our first option is a long call. We're going to buy one CHS March 60 call at 4. Remember, when you buy a call, you've bought the right to take action. And the action I'm going to take, I'm going to be able to buy that stock at 60. However, for the right to buy at 60, I had to pay 4. Now that 4 is technically $400 because we're always going to use a per share amount. Remember, when we talked about the components of the option, the 1 represented 100 shares. So the 4 would be multiplied by the 100 shares and be 400. But while I'm doing my T-chart, I like to use just a per share amount. It tends to be a little easier at the end, especially if the test gets fancy and they decide to give you more than one contract. Multiply at the end, much easier. Now, our first calculation is going to be the break even. The break even on the long call. So when you calculate the break even, you're going to assume that you exercise the option. Exercising a long call gives me the right to buy the underlying security. And as we said, that price is locked in. So we're going to buy 100 shares of CHS at $60 a share. So as a recap, we bought the option and paid 4, and we then bought the stock. We're pretending, because we want to calculate our break even, that we bought the stock at 60. So all the out of pocket is $64 a share. In order to break even, remember, to break even, you're not going to make money, you're not going to lose money, you're going to net out 0. So if your cash out or your debit is 64, that means that you have to get 64 in. In other words, if the stock trades at $64 a share, you would break even as the buyer of this call. Not make money, not lose money, but break even. In other words, the same amount of money out is the same amount of money in. The maximum gain. Well, we're going to go through the same thing. We're going to buy the option, but remember, calls are going to want, buying of calls, you're going to want the price to go up. We're bullish on the stock. Bullish on the stock, on the CHS. Well, how high can the stock go? Theoretically, the price of the stock could go to infinity and beyond. Yeah, there's a little Toy Story reference there. So if CHS goes to infinity, well, clearly the option is in the money, right? Because options are in the money. It's a call option when the current market value is above the strike price. And of course, the current market value of infinity is way above 60. So we're going to exercise this option. And when exercising a call option, we have the right to buy the stock at that locked in price at 60. So out of pocket, we've only paid $64. But wait, remember, the price of the stock is trading theoretically at infinity. So basically, that's my maximum gain. I like to call it sometimes Berkshire Hathaway land. Is that stock's trading? Well, it's up there. Now, we've calculated our break even. We've calculated our maximum gain. But I want to also know, how much could we possibly lose? Rule of thumb, you can only lose what you pay. So because I paid $4 a share, or a total of $400, that's my maximum loss. Now, Think about it. I have the right to buy the stock at $60 a share. I gain if the price goes up, but I would lose if the price went down. And theoretically, the price of the stock could go all the way down to zero. It really wouldn't make any sense for an investor to buy the stock at 60 when it's trading at zero. So instead of buying the stock at 60, I'll lose my premium. Now, think about it. What if I didn't have this option? What if I went out and bought 100 shares of the stock and paid $60 a share for the stock? If the stock went down, the price plummeted to zero, I would have lost $6,000. That's 60 times 100. So now you understand why individuals buy options. In this particular case, why they would buy a call option. Because instead of investing the $6,000 in a stock, I put up $400 and I wait to see what happens with the stock. If the stock price moves in my direction, I exercise my option. If it moves opposite, I say bye-bye to the $400 and I move on to the next investment. Works for me. So, going back to our chart, we've talked about calls so far. The shortcut to calculate your break even is to take your strike price and add your premium. And the good news is your break even is calculated the same for both long and short calls. The only difference is where do you want the price of the stock to go? So both will break even at the strike price plus the premium, but calls will start making money above the break even, puts below the break even. Now, remember, we calculated our maximum gain on the long call. The maximum gain on the long call is unlimited. But while one man sees his treasure, the other one sees his trash. In other words, the maximum loss would be unlimited on the short side. On the long side, you can only lose what you pay. But remember that premium gets paid to the seller. So the seller gains the premium. Let's put this to practice. Remember, how do you get good at options? Practice. So we're going to buy an STG September 30 call. I didn't have a contract amount in there. If the test does not give you a contract amount, then it defaults to one contract. So since I'm buying a call, what's my market attitude? Am I bullish or am I bearish? Well, go back to your chart. Matter of fact, it's not a problem if you refer to your chart because you're practicing now. So my chart says buying calls. That's a bullish strategy. The action, well, buying calls also gives me the right to buy. Remember, when you buy an option, you always have the right. And since I bought a call, I have the right to buy. Looking at my chart, my break even, I take my strike price and I add my premium for a total of 38. My maximum gain today, tomorrow, and 2 years from now on a long call will be unlimited. But whenever you buy, whether it's an option, stock, anything, the most you can lose is what you pay. And in this case, I paid $800. Now, we didn't go through the T-chart for short calls, but I did give you the shortcut. So in using the shortcut, we've sold a call. Selling a call, well, that's the opposite of buying a call. If I know buying a call is bullish, then selling a call's got to be bearish. And the action, because I've sold, I'm now obligated. And in this case, I'm obligated to sell the underlying security. But don't forget to calculate the break even on a call option. You're going to take your strike price and you're going to add your premium. So altogether, my break even is 87. My gain, well, I get to keep that premium that the buyer loses, but I don't think I like this one. My maximum loss is unlimited. That's a little scary. When we talk about our hedging and our advanced options, we'll talk about how to maybe eliminate or protect ourselves from an unlimited loss. But for now, we're just looking at single option strategies. So I've got this short call. My market attitude is bearish. I'm obligated to sell. My break even is 87. Maximum gain is 700. And my maximum loss, scary but true, is unlimited. Now, puts, not as easy as calls. I think calls more intuitive. Puts, you're thinking the opposite. And so we're going to use both sides of our T-chart here to calculate our break even. Remember, doesn't matter if it's a call or a put. If you buy an option, you have to pay for that option. And in this example, we've paid $5 or $500. That's $5 a share or $500. Now, when you buy a put, you have the right to sell the security. I'll say it again and slowly. When you buy a put, you have the right to sell the security. So what price am I going to sell at? Well, the price that's locked in, 70. However, I've got 70 in. Guess what? I've just sold a stock that I don't even own. But in order to break even, whatever I receive in, I've got to pay out in total. Or whatever I pay out, I have to receive in. Bottom line, I've got to go buy the stock. And I don't want to pay any more or less for the stock with the option combined that will net me more or less than 70. So I want to hit 70 right on the nail. And what price would I pay for the stock in order to do that? If you guess 65, you got it. So if the current market value of the stock is 65 when I buy the stock, plus the 5 that I've paid out, that gives me my 70. Remember, puts are a little opposite. So when we get to our shortcut, we'll slow it down a bit. To calculate the maximum gain, and hey, I'm like everybody else, I want to know how much money can I possibly make with this strategy. So to calculate the maximum gain, I've got $5 a share or $500 that I've paid out. Now, once again, I've just sold some NTS stock that I don't even own. However, I can go out and buy it. Now, when we were long the call, we were bullish on the stock. Now that I've bought the put, however, my market attitude, I'm bearish on the stock. In other words, I anticipate the price to go down. And how low can it go? Well, there's never a ceiling because the price could go all the way up to infinity, but there is a floor. The lowest the price could drop to is 0. Now think about it. You've bought the put, the stock's dropped to 0. So out of pocket, you've only paid technically $5 a share, but you're able to sell that stock for $70 a share. I think you're doing pretty good there. So if I'm totally out of pocket 5, but I can sell the stock for 70, how much did I make? I made 65 or $6,500. $65 a share or $6,500. Now you might be asking yourself, wait a minute, that 65 looks familiar. The break even was 65 and you're telling me the maximum gain is 65 also. Well, that's not a coincidence. What you want to remember, however, the break even is always represented by a per share amount. The stock is trading at 65, 72, 39, whatever the case is, the break even is per share. Once you take that break even and multiply by the number of shares that you have, and remember, how do you figure out the number of shares? Well, you're going to look at the number of contracts. In this case, I have one contract, and one contract equals 100 shares. So I know that I'm going to have 65 times 100 shares, or $6,500. But what if instead I had 2 contracts? Now, don't get this wrong on the test. If you have 2 contracts, you will still have a break even of 65. Because remember, I told you, break evens are calculated based on a per share value. We want the price to go to 65 to break even. Actually, I want it to go down because I want to make money, right? But if it gets to 65, I break even, period. Even with 2 contracts, with 10 contracts, it doesn't matter. However, if this investor were to invest in 2 NTS January 70 puts, instead of their maximum gain being 6,500, it would be 65 times 200 shares, or $13,000. See what I did? I took my break even and I multiplied by not 100, but 200 shares. By multiplying by the 200 shares, that gives me 13,000. I wanted to say that. Didn't want to put it up here to confuse you, but I wanted to let you know that taking that break even, you also have to look at the number of shares in order to calculate the maximum gain. However, our maximum loss remains the same. Whatever you pay, that's how much you lose. So if the maximum loss is 5, that's how much we paid, $500. In other words, if the price goes up, I don't think I'd want to sell my stock at 70 if it's trading at 85 or 90 or 905. Who knows? So let's fill in our chart again. Our break even for the long and the short put strike price minus the premium. Strike price minus the premium. Our break even times the number of shares gives us our maximum gain on the long side, but it's also the maximum loss on the short side. And of course, what one man sees as junk, the other one sees as a jewel. In other words, what the buyer loses, the seller gains. If the buyer loses the premium, well, that's what the seller receives. So we filled out our option chart for our basic option strategy so far. And as you can see, the calls have the same break-even calculation. Puts, long and short, have the same break-even calculation. But you have to remember, we don't see the word unlimited on the put side. That's only on the call side. So when you see unlimited, especially that unlimited loss, notice that that is a short call. And for many of the exams, you'll need to not only know that unlimited loss, but you'll need to figure out, hey, what kind of investor would be a good investor for a short call? Who can afford to lose an unlimited amount of money? But that will be for you to decide. For now, we're going to look at a couple more calculations. This time we're going to buy one MTH December 65 put at 4. Remember, we're going to look at our action. The action says we're going to buy, and we look at our type. We're going to buy a put. So buying a put, our market attitude is bearish. So when you buy a put, you're bearish. You anticipate the price of the underlying security is going to go down. But our action, because we think the price is going to go down, we want to get out and sell as soon as we can. Kind of like Shark Tanks, I'm out. So remember, when you buy an option, you buy the right. But you need to look at the type of option to determine if you have bought the right to buy. And in this case, we bought a put, so we have the right to sell. Our break even, well, with puts, we're going to take our strike price and we're going to subtract our premium. 65 minus 4 gives us 61. The maximum gain, do you remember the trick? We've already learned how to calculate our break even. And remember, I said if they don't give you the number of contracts, then it always defaults to 1. So if you have 1 contract, that represents 100 shares. 100 shares times 61 gives you $6,100. Now, what if we had 2 contracts? Then instead of $6,100, we would have $12,200. All I did was multiply the 61 times 200, the number of shares. What if you actually had 5 contracts? 5 contracts would equal 500 shares. However, our break even would still be 61. But with 5 contracts, if you do the math, the maximum gain would be $30,500. Now, can you trade 5 contracts? Absolutely. 10, 15, 1,500 contracts? Yeah, you can. So as you can see, the numbers can start to multiply and multiply and multiply, and that maximum gain could look pretty good. And with puts, well, the maximum loss isn't going to be unlimited. In this case, our maximum loss is going to be what we paid, or the $400 in this case. Now, don't get me wrong. We paid $400 because we have 1 contract. But let's say you did invest in 5 contracts, then that would be a $2,000 loss. So the gain can multiply, but so can the loss, depending on the number of contracts you decide to trade. The next strategy tends to be the one that challenges students the most: selling a put. When you sell, a put, you have sold your rights. So that means you have obligations. But you're selling a put, your market attitude is bullish. So what happens is you're thinking about selling, 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 and in your mind, selling means bearish. Well, not when it comes to a put. So selling a put is actually bullish. And the reason behind it is because of what you're obligated to do with the underlying security. So here we've sold one SBT November 50 put at 3. We already established we're bullish because the action is we're going to be obligated to buy. So you sold, which gives you the obligation. But since you sold the put, you're obligated to buy. Like I said, if there's one single option strategy that tends to confuse students, it's going to be this one. But don't worry, this won't be the last time we see this. If you come back and visit me on Monday and Wednesday, we'll talk about option contracts, and we'll start playing around with these single option contracts, adding them to stock, adding them to another option. The sky's the limit. So we still have a put. And as we've calculated, our put break even is our strike price minus our premium. Doesn't matter whether you're long or short, the break even is the same. In this case, it's 47. But remember, we're bullish on this stock. So we want the price to go in which direction? We want it to go up. And we want it to go up above 47 because then we'll start making money. The maximum gain will be able to receive in our premium. The maximum gain is our premium. Now, remember what I said also, with puts, you're not going to see an unlimited loss. I'll say it again. With puts, you will not see an unlimited loss. And that's for our single option strategies. The loss will be calculated by taking our break even and multiplying by the appropriate number of shares. Since I don't know how many contracts, I'm going to assume one. That's the default. One contract equals 100 shares. So 100 shares times 47 gives us $4,700. So I know that my break even is 47 and my maximum loss is $4,700. But make sure you look at the contracts because they might sneak in one of those contracts, 2 or 5 or whatever the case is. And then they ask you to calculate the break even. You go, oh, I've got 2 contracts, so my break even, wrong answer. Your break even is still going to be 47, $47 per share. But if they happen to sneak in 2 contracts on you, your maximum loss will increase from $4,700 to $9,400. Did you see what I did there? I took my break even, looked at my contracts. If I had 2, that's 200 times 47. But they might be nice and not sneak that in. So looking at our chart again, we've got our long calls, our short calls, our long puts, and our short puts. Long calls are bullish, so are short puts, and our long puts are bearish, similar to our short calls. We've got our break evens, max gain, max losses. And if you don't remember anything else from this webinar, you should remember this tool. It was actually created to help you answer the questions on your exam. And speaking of questions, if you still have questions after this webinar, we'll stick around for a bit and we will be more than happy to answer them. If not, everyone have a nice weekend and we'll see you next time. Take care.